It's very easy to print a lot of money. Everybody loves it. Big party, but the backside is really quite damaging. That's what 2000 was. That's what 2008 was. This one is even larger than those other two credit cycles, more ill-advised, and is going to be more painful.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Chris Martenson from Peak Prosperity. Chris, thank you so much for joining us today.
It's my pleasure to be back with y'all.
All right. Now, the first topic I'd like to discuss is about the stock market. You recently wrote an article about this and saying, well, is this it? Is this the crash that you've been predicting for so long? And you're saying that it might not actually be the crash. What is your perspective right now?
Well, it's, my view is that watching the prices of stocks, what you're really doing is you're watching the effects. You got to understand what the cause is. And so in this story, what I do in that article too is I rewind it a bit and I say, look, these aren't your average ordinary stock bubbles that happen because everybody sort of gets excited. These are the direct outcome of central banks pursuing what are called credit cycles, which they've tried to replace the business cycle with. Now, they didn't like business cycles. Things went up, things went down. And so in order to get around that, they thought, hey, we'll just create these ample credit, we'll drop interest rates, we'll flood the world with liquidity, and that will help us get past these troubling spots. And Greenspan started that, Bernanke and Yellen continued it. We'll see what Powell's going to do. So really what I'm asking people to do here is watch what the central banks are doing. Listen, they engineered this. Everything was rolling over big time in late 2015, early 2016. That was clearly a time when things were going to roll over, but we had the European Central Bank come out and pour on the most liquidity ever by all the central banks combined during that next part of the crisis there. 2016-17 saw the most money printing in all of history, even worse than, worse, whatever word you want to use then. During the 2008-9 period, during the 2011 and 13 period was another big printing spree, and so on. So what are they up to? Well, listen, we've seen these rescues. We've seen that the authorities, I have no interest in watching things break down, but every world central bank is committed right now to tightening liquidity. Whether they do that or not is why I have to still put a question mark on there. If they were going to commit to their current plans of quantitative tightening, the answer is yes, this is it. This credit cycle is going to burst. Will they let it burst before they freak out and reverse course? That's the question mark.
With regards to that, you said that bubbles burst from the outside in, starting at the weaker places at the periphery before progressing to the center. So what are we seeing right now? Is that what we're seeing?
We are seeing that, and we've been tracking that at Peak Prosperity. We've been tracking that exact dynamic for, 6-8 months now. When we first started to note, if your listeners remember, Turkey, was having all these issues. Its currency was weakening. And of course, Erdogan was putting up a big fight with NATO. And so there were some geopolitical angles to this. But Turkey started to get into a lot of trouble. Venezuela, of course, has just been breaking for a long time for a variety of different reasons. But then we saw Argentina get in trouble. And then we watched South Africa. So those are the weaker periphery countries. If you see a global contagion of a liquidity crisis start, it always starts out there, at the weaker players first. It's no different than saying who gets in trouble in a society first. Well, it's going to be the people living paycheck to paycheck, living at the edge. They're the ones who are going to feel the impacts first. So that's what we mean from the outside in. We don't track what treasuries are doing quite as much as we track what triple C rated or junk rated debt is doing, because that's where the trouble starts. If you want to have an early warning, you look at the edges. So yes, we've been seeing the edges get in a lot of trouble around the junk rated debts. We've been watching credit spreads start to widen out. We've been watching, I think, what are we up to? Maybe 12 or 13 stock market bear markets out there across the world. Again, all in the weaker countries. And that's what we're watching. So that's still proceeding, and that's what you get at the tail end of a credit cycle. Another article I wrote is titled "Easy Come, Hard Go." It's very easy to print a lot of money. Everybody loves it, big party, but the backside is really quite damaging. That's what 2000 was. That's what 2008 was. This one is even larger than those other two credit cycles, more ill-advised, and is going to be more painful.
Now, can you spell out a bit more about what this will actually look like for the average person? You're saying this is going to be more painful than other crises. Why?
Well, it's really the business cycle was a well understood phenomenon, and you understand how a business cycle gets going. Like all the businesses start to feel they're doing well, and they hire more people, and they pay a little bit more money in wages, and everything starts to get going, and then towards the top of that, really dumb things get done. There's a lot of capital floating around. Loans are taken out that shouldn't be taken out for non-productive business enterprises. And then they end up bursting at some point. The pets.coms and the web vans and all these dumb ideas, off they go into the sunset. The Fed didn't like that. 2000 sort of worried them a little bit. They thought, well, listen, let's not do that again. Let's prevent that pain. So in the credit cycle, what happens is you have a lot of non-productive enterprises get propped up. And that what happens when it bursts, when that tide goes out, you suddenly discover that there's a whole lot of debt that'll never be repaid. That has huge damaging impacts on the overall economy. You find you have a lot of leverage speculation creating the appearance of activity and wealth when in fact it's all a mirage. So easy come, hard go is how it works when this flood goes away. Remember, 2007, we had $147 trillion of worldwide global debt. Now we have $100 trillion more than that. We're parked at around $250 trillion global debt, not including unfunded or underfunded liabilities. That's no pensions, Medicare, Medicaid, none of that. We're just talking debt. That's a huge amount of debt. We have about 12% of companies right now are zombie companies, meaning that they can't even make their debt interest payments off of their operating earnings. Those all go away. That's a global statistic. So when you look at this right now, Elijah, what we see is that there's a ton of dead wood, dead companies, zombie companies, bad ideas that have all been they all make sense when there's a lot of liquidity out there. But when, not if, but when that liquidity retreats, all of that stuff is revealed as dead wood and it burns away. And it's pretty painful. Jobs get lost for the average person. They're going to see a lot of panic in the streets, falling asset prices. Remember, we had bubbles in stocks, bonds, and real estate. We're already seeing that real estate bubble prick just with a 5% rate of interest in the United States on a 30-year conforming mortgage. But we're seeing this in Australia, property price declines, in Canada, Toronto, Calgary, and Vancouver, price declines, London. So this has been a worldwide phenomenon, and we're starting to see the first signs that it's retreating now.
Now, as for you're talking about this being a worldwide phenomenon. You've also talked about in an article about how there's this divergence happening between economic output and debt. Is this a worldwide phenomenon that there's, debt is growing, but economic output isn't growing as much?
Well, absolutely. And this is why, in my work, I combine energy and the economy and also the environment. You have to really look at all three together. One of the things that the central banks have been doing, they're just ensconced in this world of the first E, the economy. That's all they understand. They got a lot of complicated formulas and a lot of math and a lot of geeks working on that stuff. And what you notice that they've done in the United States is they've been on a 30-year plan of reducing interest rates from the highs around 1980 on through to current, right? So just reducing. And now, they got all the way down to 0% rates of interest, negative even in Europe. And what did that get them? Well, not a lot. So for that last $100 trillion of debt I just talked about, how much did the global economy grow? A tiny fraction of that amount. So what we're seeing is more and more and more debt is doing less and less and less. That we could understand just in pure economic terms if we wanted to. But when you understand where we really are in the energy story, you know that that kind of high growth that we got 30 years ago was only possible because we had high net surplus energy to work with. We don't have that nearly as much to work with today. So growth is just going to be harder to come by. The difficulty in this story is the central banks, they're addicted to this idea of growth. Not them per se, but the money system, the banking system needs that growth or it gets very cranky, unhappy, if not collapsy. And so what happens is the central banks are trying desperately to engineer growth using debt when it doesn't even make sense on economic terms. But once you understand the energy story, it really doesn't make sense. That's what they're pushing against here. It's a real a task that's destined to fail at some point.
Now, getting into that energy story, you said, they're so intertwined, energy and the economy. You've talked about how this infinite growth is really impossible, that people say that, the economy is going to grow by, 5% or whatever a year, and that's really unsustainable. You talk about in an article where it's, if there's more demand, then essentially just suppliers will appear out of nowhere to supply for that demand. But really, that's not how it works. There's a limit. There's the natural resources. That's the limit. We live in a finite world. Can you talk, more about this?
Well, sure, I could. And it should be something that's so obvious and taught in grade school that we shouldn't. I mean, everybody should be bored and turning this off right now because they're like, oh, yeah, I learned that a long time ago. But it doesn't it's still oddly like this, mysterious concept to most people because it's really not talked about. And it's this idea that, you can't run an infinite model on a finite system. The world is a sphere. It's got a known volume. It's got a known surface area. We have so much fresh water. There's only so much soil. There's, only so many natural resources out there. And what most people are unaware of is the role of energy in creating everything we see. And the reason I make that a separate E all on its own, and I don't just make it a C and I call it commodities, right, is that energy is the master resource. If you have energy, all other commodities can be, you can have access to them. But without energy, you got nothing. So where are we in the energy story? And there's some statistics out there people are really unfamiliar with. Yeah, we've been burning oil since it was first drilled in 1859 in Titusville, Pennsylvania. But in the last 22 years, half of all the oil ever burned in human history has been burned just in the last 22. And we're about to burn that a whole nother amount that would be equal to everything we've ever burned in all of history in the next 18 years, right? So this is just the nature of using a resource exponentially. That's what we're doing. We're burning through oil at an exponential pace. We want to burn 1-2% more year in, year out. And so that's the train we've been on. And it's just going to create an enormous problem at some point because we have no plan B for how we're going to replace fossil fuels. And, longer story. I know we don't have time for it now, but, if people could just please put pencil to paper and look at how much of a gap exists between current alternative energy sources, wind, solar, hydro, stuff like that, and how much we're actually consuming, they discover that there's an enormous predicament coming, and it's coming soon by my estimation.
No, you're saying it's coming soon. Like what kind of time frame are we looking at?
2020 to 2022 is somewhere in the zone where we run into a huge supply problem for oil. This is simply a math problem based on the fact that we had 4 years of really, really depressed energy exploration budgets. These first investment decisions, or FIDs, by the major oil companies were at all-time lows for the last 4 years, 2014, 15, 16, 17. We'll see how 2018 finally clocks in, but it's going to be low as well. Not quite as low, but still low historically. And when you're not spending money to find oil, you don't find it, then you can't pump it. And so there's a big lag. It's about a 5 to 7 year lag in the oil business. And so that first time we would start to see that start to show up could be as early as 2019, but I'm expecting it really more to show up 2020, 21, 22, somewhere in that zone. And then we're going to have real difficulties in supplying ourselves with oil. Hey, the EIA is talking about it. The IEA is talking about it. A number of major investment banks have caught on to that thesis as well. So that's coming. And that's just, nobody can fix that. I don't care how much money you have. You have to find it first, and it just takes time. So that pig's already in the python, and that's where that comes. Listen, a world with how much debt will the world have in 2022? I'll make a number up. 300 trillion if we keep at current pace. What does $300 trillion and $150 a barrel oil look like? Who wins that battle? Who loses? Listen, that's called 2008 all over again. Many people think that was the pin that pricked that was just, bubbles bursting in housing. To me, it was $147 a barrel oil in July of 2008. Hey, that's what took Greece out. That's what caught, Europe short. That's what really started to put a pin in the bubble here as well. So that's what I'm looking at again, is something like that. And this all, Elijah, centers on this very simple idea, which is oil is finite and it's getting harder and harder to find. The shale story notwithstanding, a lot of details around that too.
Definitely. I mean, you're talking about how these two things are coinciding, this energy crisis and also the economic crisis that seems to be very close at hand. Now, essentially, if we look at how do you see us moving out of this? I mean, if there's, limited resources and that's going to constrain economic growth, we can't have exponential growth forever. And we're going to see this economic crisis and we're going to see probably higher energy prices. Like, how does this all resolve and where do we go afterwards?
Well, this has been one of the weirdest periods in human history. But let's just talk U.S. history here for a second. Sometime around 1985 or so, give or take a few years, we decided deficits don't matter, debts don't matter. And we've been increasing our debts at roughly twice the rate of our underlying economy. Now, listen, even without the resource story, that's a math problem waiting to happen, right? So, if your credit card debt was going up at 10% a month and your income was going up at 4% a month, sooner or later, you too have a math problem. Not hard to understand. But we convinced ourselves in this country collectively that somehow debts don't matter and we'll always grow our way out of it and all this. So to your listeners, if you just look at the total IOU pile of the United States. And by IOUs, I mean all the debts that exist out there, right? Student loans, auto loans, corporate debt, federal, state, municipal debt, but also unfunded liabilities, pensions, both at the municipal, corporate level. You add all those IOUs up in a big pile, and you discover that pile is now 1,100% of current GDP. And Elijah, when I look at a pile like that, there's no way to get out from under a pile that big except through rapid growth. How much? More than we've ever seen in our nation's history. And are we going to get that rapid growth? Not without a huge pile of energy I haven't found or seen yet. So when you look at a chart like that one I'm describing, where you're looking at debt to GDP and it's just been climbing, what you have to ask yourself is an answer is just one question. Who's going to eat the losses? So you asked, what's the way out of this? There is no way out of this. That debt's going to have to be repudiated. Those IOUs are going to have to be reduced in some way. And those are going to be reduced in the normal ways. Hey, we're so sorry. Your pension went bust. We handed it to the PBGC. You're getting 40 cents on the dollar. Hey, did we say you could retire at 67? We meant 77 or whatever the answers are going to be. I don't know. But they can't be paid. So we've been pretending as if we can make all these promises and they'll be kept. They won't be kept. They can't be kept. So that's what people need to be ready for and understand is that that's coming. Now, here's the thing. There's only two ways to repudiate a debt. One is to not pay it back. And the second, if you're a government, is to print your way out of it. And so that's what I think people need to be prepared for is the next layer of printing. The first round of printing went to the banks, the big banks, to make sure they didn't eat the losses. Politically, I don't think that's going to be possible. We're seeing that in the riots in France, the Catalonia breakaway, Brexit, Trump, all that. That's populism on the rise. Basically saying, hey, you guys bailing yourselves out and making yourselves even wealthier at the top end is causing a lot of social friction, surprise, as historically every time it's been tried. The next round of printing has to go to the people or money for Main Street. And that's where we start to see a lot of inflation take hold. That's still a number of years out there. But again, I would put that out there in the 2020 to 2022 timeframe at the latest. And for anybody listening to this, I got to tell you, that's not very far away. And there's a whole lot you need to do to be prepared for when that time comes. And if you think you just wait and see if that develops and then get ready when that time comes, you won't have time. You may not have the resources. It may be more difficult, but it's coming. Really, that's the only question, Elijah, to answer is who's going to eat the losses? The banks are going to say not us. The government's going to say not us. The taxpayers, I think this time, are going to say not us. And that's where the fight starts.
Now, before we let you go, I'd love to have you share where people can find you. And really one thing that I really like to have the guests talk about on this show is, how to prepare. And I think one of the things that I was reading an article that you wrote, you write amazing articles, and one of them was about a preparedness strategy that you're going to be implementing. If you want to talk about that, you're going to have people kind of join you on a whole weekend without electricity, correct?
Yeah, so this really was put forward by a reader comment, sort of sparked the idea, but had been percolating for a while because we had, of course, members who were there in Houston during Hurricane Harvey. We know people who were for Charlie that came up across the Florida Panhandle, and also we directly know people who lived in Wilmington when Florence came through. And in each case, we gathered data from people, and they all said, listen, we're very well prepared. We've been preparing for a long time. But once we got into it, we discovered a lot of shortfalls. And so really, the idea here is that a plan is one thing, but a plan without practice is still just a plan. So the idea here is to encourage people. We're all going to pick a weekend. We're going to pick a weekend, and we're going to say, hit your main circuit breaker and turn it off on Friday. We flick it back on Sunday, and we ask some questions. What happened? And people were discovering things like, oh my God, these little hand crank solar radios I got, they didn't work, or these batteries I forgot about and this thing had corroded, or oops, I thought I had these things, but I didn't. So that's the idea, is just to take our plans, put them to practice, and see, let the chips fall where they may. I'm just a huge believer in planning and practice.
All right. Well, the website is peakprosperity.com if they'd like to learn more about that, and also your other work. Any last thoughts you had?
Well, no, it's just this is the time to get prepared. And really, it's not just economically. Look across the world, and it's clear huge, massive changes coming in the environment. I know we didn't get a chance to talk on that much, but this really says this is the time for people to get prepared. And, of course, that's our mission at Peak Prosperity, is not just to point all this stuff out, but what are you going to do about it? That's really where our heart lies. So I would invite people, yes, please come by peakprosperity.com, check it out, and join the community.
All right. Once again, thank you so much for your time, Chris.
My pleasure.